The live intraday price for Opendoor Technologies Inc., Nasdaq Open, stands at $7.52 per share, showing a decrease of 1.57% today as of 1:03 p.m. EST on October 15, 2025. This stock has been a magnet for speculation, but what most retail investors miss in the day-to-day noise is the profound shift in institutional positioning that has quietly been underway, suggesting a deeper, more calculated play than simply riding the waves of housing market sentiment. You might see the share price drop and think, just another tough day for a tech-enabled real estate company in a high-interest rate environment. But the reality is that certain large funds have been systematically increasing their exposure to Opendoor, even as others reduce theirs, creating a fascinating high-stakes tug-of-war for ownership that completely recontextualizes this small dip. This is not just random selling pressure, it's a battle between conviction and caution in one of the most unpredictable subsectors of the market. The general market expectation for Opendoor is usually a binary bet. Either the I-buying model, instant buying, is fatally flawed and cannot withstand a slow or high-rate housing market, or it is a glimpse into the inevitable future of real estate. The reality, however, is far more nuanced, rooted in the company's capital structure and its ability to manage inventory risk. The dramatic guidance miss following the Q2 2025 earnings report is still casting a long shadow over the stock. While Opendoor beat on both top and bottom lines for the second quarter, posting $1.57 billion in revenue against estimates of $1.5 billion and achieving a positive adjusted EBITDA of $23 million, its forecast for the upcoming third quarter threw the market into a panic. Management projected Q3 revenue to be between $800 million and $875 million, which was dramatically below the street's consensus of approximately $1.5 billion. This steep reduction in expected revenue, signaling a significant slowdown in sales volume, immediately created the current tension between hope and fear. Shares plummeted in the aftermath because the low guidance suggested that the macro headwinds, namely high mortgage rates and low housing supply limiting turnover, were cutting into the core business model much harder than anyone had priced in. This is the common narrative. Opendoor is struggling with housing market conditions. But here is where the contrarian view surfaces. The stock's year-to-date performance is still exceptionally strong, reflecting a massive rebound from its 52-week low of about $0.51 to today's price of over $7. This resilience suggests that a significant portion of the market is looking past the near-term guidance. The fact that the company, at the time of the Q2 report, authorized a new $200 million share repurchase program for the third quarter is a powerful signal of management's confidence in their capital position and a belief that the stock is undervalued at current levels. They are using their own cash to buy back shares when the stock is depressed due to what they view as temporary macroeconomic-driven weakness, rather than a structural failure of the business model. That $200 million vote of confidence is a reality that often gets overshadowed by the sensational headlines of an earnings miss. Today's intraday volume, which is already running at over 71 million shares, suggests intense trading activity, a hallmark of deep disagreement between buyers and sellers on what Opendoor is truly worth. A closer look at the technical movements over the past few sessions confirms this volatility. Today's trading range, with a high of $7.84 and a low of $7.34, shows a 50-cent swing, which for a stock in this price bracket represents a significant level of intraday risk and opportunity. The overall downtick today follows a pattern of high volatility over the past 3 months, where the stock has been moving far more erratically than the broader U.S. market. This is partly due to the recent rise in interest rates, which directly impacts the housing market, Opendoor's immediate operating environment. When rates rise, home sales volumes typically drop, and holding times for inventory increase, both of which stress the I-buying model. For Opendoor, managing inventory has been a constant struggle, with reports indicating a substantial percentage of its acquired homes are sitting on the market for over 120 days. Inventory holding time is the lifeblood of this business, as prolonged holds erode margins due to capital costs and potential price depreciation. The market is weighing the short-term pain of these inventory dynamics against the long-term proposition. Now let's talk about the big players. Institutional ownership is a critical lens through which to view Opendoor. As of the most recent filings, institutions held approximately 53.7% of the total shares outstanding. What's compelling is the sheer number of significant position changes. While major institutions like Vanguard and BlackRock reduced their positions in the last reported quarter, which aligns with the cautious narrative, several other sophisticated trading firms substantially increased their stake. For instance, Two Sigma Advisors LP saw a massive percentage increase in its share count, as did other aggressive players like UBS Group AG and Citadel Advisors LLC. The reality is that the net institutional activity is complex, characterized by both large sales from passive index-style funds and massive accumulation from active high-frequency traders and hedge funds.
This is a classic sign of an asymmetric bet. Some believe the downside risk is too great and are exiting, while others believe the current price presents a deeply attractive discount for a turnaround, doubling and tripling down on their exposure. The story here is less about index funds exiting and more about the influx of speculative, conviction-based capital from active managers, which signals a different kind of belief in the underlying model's eventual success. This disparity in positioning is what makes Opendoor a trader's favorite and an analyst's puzzle. To understand why this is such a contentious stock, we need a brief look at the fundamentals. Opendoor is primarily a technology-driven real estate platform that offers homeowners a quick, all-cash offer for their homes, often closing in a matter of days. The company's goal is to digitize and streamline the highly fragmented and friction-filled process of selling a house. Their operating model, known as iBuying, involves using proprietary algorithms to accurately price homes, buying them, making light repairs, and then quickly reselling them for a profit. The core thesis is that data and technology allow them to compress the transaction time and reduce overhead costs relative to traditional real estate brokerage. The business is fundamentally a scale-based, high-volume, low-margin operation. Past performance has shown dramatic revenue growth during periods of low interest rates and high housing turnover, but also crippling losses when the housing market slowed, forcing them to sell inventory at a loss, a vulnerability that has scared off many value-oriented investors. The company has yet to achieve sustained profitability, with TTM EPS still negative, which is why the stock is primarily treated as a growth or turnaround speculation rather than a stable investment. Looking ahead, the market is bracing for the Q3 2025 earnings report scheduled for November 6, 2025. The consensus EPS forecast is a loss of -$0.08 per share, an improvement from the -$0.13 loss reported in the year-ago quarter, but the revenue number is the main point of contention after the weak guidance. Analysts' consensus revenue forecast is around $881.985 million, aligning with the low end of management's previously provided range. This is the next major catalyst. If Opendoor can beat this deeply reduced revenue expectation, or, more importantly, show meaningful progress on its key operating metrics, such as reducing its time to sale and increasing its contribution margin per home, the current pessimistic reality could quickly shift back toward a bullish expectation. However, if they miss even the adjusted lower guidance, the recent rebound could face a significant test. The company's ability to generate operating cash flow, which has historically been erratic, will also be under the microscope, as consistent positive cash flow is necessary to fuel the inventory engine without constant shareholder dilution. The longer-term outlook for Opendoor hinges on macroeconomic stability. If inflation cools and the Federal Reserve begins to ease monetary policy, leading to lower mortgage rates, the resulting increase in housing transaction volume would be an immediate and powerful tailwind for the iBuying model. Until then, Opendoor must demonstrate disciplined capital allocation and superior operational efficiency to its competitors. Their success is truly dependent on proving that their algorithmic pricing and logistical capabilities are truly robust enough to generate repeatable profits, even in a challenging sideways real estate market. This is the ultimate test of the tech part of the business model. Is the technology truly a moat that allows them to outperform traditional methods, or is it just a high-cost method of being a home flipper? The market is currently betting against the latter, as evidenced by the low analyst price targets, some of which hover significantly lower than the current stock price, creating an enormous gap between the current trading price and the most conservative future valuation estimates. That $7.52 price is telling us that despite analyst caution and soft guidance, significant mass of investors believe the business is worth far more than the $2.64 median analyst target. This is the expectation versus reality at its extreme. For those of you tracking this space, I have a question for you. Comment below what you think the optimal price-to-rent ratio is for the iBuying model to consistently achieve sustained profitability. Your answers will show just how complex the variables are here. In closing, Opendoor Technologies is a story of a business model constantly fighting against the macro environment. Today's decline is a reflection of persistent anxiety over their ability to execute against the backdrop of a slow housing market, a fear cemented by the very weak Q3 revenue guidance. Yet the price strength and the targeted institutional accumulation from sophisticated funds suggests a deep conviction that the model's eventual success is being unfairly discounted. The company's value is currently not in its earnings, which are negative, but in the optionality of its market position and the possibility of a return to a high-volume housing market. It is this tension that will continue to dictate every volatile swing in Opendoor's stock price over the coming quarters.